You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment and 1031 exchange expert, Chay Lapin. Now, Chay is the president of K Properties and Investments, a national Delaware statutory trust investment firm. K's platform provides access to the marketplace of DSTs from over 25 different sponsor companies, custom DSTs only available to K clients, independent advice on DST sponsor companies, full due diligence and vetting on each DST and DST secondary market. Now, K Properties team members collectively have over 115 years of real estate experience, are licensed in all 50 states, and have participated in over 15 billion of DST 1031 investments. Now, Chay is a leader and specialist within the 1031 DST and real estate offerings market, and he provides insights to clients nationwide concerning multifamily and commercial real estate, DST, TIC, and fractional triple net properties. Additionally, Chay has sponsored and co-sponsored the syndication of over 2 million square feet of DST properties in the multifamily, net lease, industrial, and office sectors, as well as invested in and operated multiple net lease assets and residential properties throughout the United States. A graduate of the University of California, Los Angeles, Chay was a 4-time academic All-American water polo athlete and recipient of the prestigious UCLA Athletic Department Most Courageous and Character Award. Chay was a top-ranked United States performer and represented the USA in the 2012 London Olympics Games on the U.S. Men's National Water Polo Team. So, guys, I'm excited to have Chay here today. So, with that, Chay, welcome to the show, buddy. How you doing?
Good. Thanks, Kevin, for having me. I appreciate it, and glad to have some fun here.
Yeah, it's always fun to have an Olympic athlete on the show.
Yeah, I don't talk about it much, but I think that it brings back the glory days and the fun, and I'm getting far away from it these days.
No, man, it's in your blood, buddy. I don't think you can get far away from it. It's always there. So, well, in any event, Chay, excited to have you here, buddy. What I love to do here in the show is, first and foremost, I always love to pass it back to you. I can read your bio, from what I put off your website or your one sheet, what have you. But ultimately, it's not the same as hearing it in your own words as far as who you are, where you came from, and ultimately how you found your way into the real estate space. So if you could, maybe take a few minutes to tell our listeners a bit more about yourself.
Yeah, no, absolutely. And, if you want me to expand in any way, but I'll give the 30,000 foot view. Really, as you mentioned, I went to UCLA, and one of the things that always interested me as a young kid, and a lot of the mentors I looked up to were, in the business world. I didn't really know where I wanted to navigate in that business world. And when I got to UCLA, one of the things that I didn't realize, which I guess is a lesson learned, but I had a great experience at UCLA, so I would never change it. But they didn't have an undergrad business school. So they have one of the best, obviously, graduate schools, but believe it or not, they don't have an undergrad program. They used to in the 90s, but they took it away, I believe. And so when I figured that out as I was picking my major, what direction I wanted to go, I didn't want to get into economics or anything like that. So I ended up doing environmental science. I just had some interest in there on that side. But I decided, I believe it was my sophomore year, I started, the internet was just exploding at that time with Google. So I was Googling UCLA alumni in business. And long story short, through, various connections and research, I basically interviewed people. I asked people to go to dinner or coffee, and I took them out. And the way that I narrowed down to real estate is the first person I reached out to said, "Hey, yeah, let's go to dinner." And he was local at a real estate company in Beverly Hills. Long story short, I ended up getting an internship there my sophomore year in college. And so I ended up working on and off. He was very flexible with my schedule. I was obviously training for athletics and then my ultimate goal was actually to go to the Olympics in 2008. And unfortunately, I didn't make the roster for that Olympics. And so, I stretched out to 2012, as we all know. But one of the things with water polo is you don't make money, right? It's for the love of the sport. Most people don't even know what water polo is unless you're from a sunshine state. And so I really decided to pick up real estate, through my experience as the internship, and he allowed me to get licensed and actually make money in college and get exposed to it. He was really gracious. Wasn't just, crunching numbers and being an analyst. I got to go out on property tours, do everything A to Z. So by the time I, finished the Olympics and I was ready to hit the ground running, I had, multiple years under my belt of real, true business experience. I was personally investing at that point in time in the sector. And so just, I got very lucky. I appreciate it. And I was blessed to get the opportunities. But I met Dwight Kay, our founder, through that period. So through the 2008 to 2012 period, he was working in the Pasadena area, which was, somewhat close to UCLA. And we would go out and get coffee again. I think a very important thing in all businesses is that networking, because these types of things, evolve, where I am fortunate enough to be today. And so he was expanding in 2011 and 12. And that's where he offered, hey, when you're done with the Olympics, why don't you come on board here? So, fast forward, we're getting almost 10 years into it. Now I'm here at K Properties.
Okay. Well, I appreciate you taking some time to give us that background there. And so that first internship, was that actually a brokerage, or was that an investment firm, or, kind of what were your roles there during that time?
Yeah. So they were primarily a multifamily brokerage. They were a group of guys who actually were very established, I believe, at like a combination of CBRE and Marcus & Millichap guys who ultimately broke off. They got so established there, and we see this a lot. They break off to create their own brand. And so they were probably 3 or 4 years into with that brand. That was one of the reasons I was fortunate to be at the bottom and get more hands-on experience. But this multifamily brokerage, they also had their own fund or whatever that all the older principals at the company would invest in. So I got to be involved in underwriting, and they managed their own properties. And then they, so it was a combination of syndications and brokerage. So I got exposure to both sides.
Okay. Good deal. So let's talk about, switch gears and talk about K Properties. And you guys are experts with DSTs, or Delaware Statutory Trusts. And, maybe let's start with the basic fundamentals, and just maybe take a moment here and tell us what is a DST, or a Delaware Statutory Trust, and what role does it play in the real estate investment space?
Yeah, absolutely. So our pretty much sole focus, as you just mentioned, is the DST structure, which, as you said, is the Delaware Statutory Trust. And really what that is it's an entity, and it's been around for a very long time. In regards to our space, it really took off in 2004 because that's when the IRS actually blessed that structure as a like-kind vehicle for 1031 exchanges. And more importantly, a like-kind vehicle when you're doing fractional ownership. You're owning a piece of X building, where previously, I think, a lot of companies would utilize like a TIC structure, maybe certain LLCs or business entities, but a lot of times those won't qualify necessarily for 1031 exchange situations. And so our founder, Dwight Kay, decided, this is the vertical. He came from a brokerage background as well prior to K Properties, but saw that there was a niche here. And the biggest niche in the why people and what a DST is you're ultimately a passive investor. That's become very popular over the last decade, and then very, very popular with the acceptance. We're not a crowdfunding site, but the whole crowdfunding world and the big companies getting involved in venture capital has allowed people to be comfortable with the passive investing, which really helped our industry. Like I said, we're not a crowdfunding platform by any means, but I think that as we see with everything, when technology starts to get widely accepted, it, by default helped our business. And so the DST is, we take a FedEx building just as a simple example, and we wrap it into the DST structure, that trust, and investors can come in and own, 10% of it, 15% of it. And the biggest item I would like to say about the DST structure is that ability not only to 1031 exchange into it, but also when the property has a liquidity event or sales, to be able to exchange out of it, where a lot of general partnerships, even some LLCs that maybe people might exchange into somehow, they're at the liquidity event, because there's the GPLPs, it technically doesn't qualify for a 1031 if everybody's going their separate ways.
Yeah, no, very interesting. And I didn't know that you could actually exchange out of a DST. So that is that is a huge benefit there. And so just break down the actual structure. So the actual does the DST acts in a capacity someone as an LP with a GP being the actual sponsor, or is that sponsor actually part of that DST as well?
Yeah, so I guess if you want to compare it to the GPLP structure, obviously in that kind of structure, the GP is making all the decisions and the LPs are kind of your passive, investors, so to speak. Mm-hmm. In the DST structure, that would be all the investors are beneficial owners of the trust, just as if you or I had a family trust. It works very similar. I might have my home inside my family trust, and then my wife and I are 50% beneficial owners of the underlying assets in that trust. So same concept with the DST. The sponsor sometimes can co-invest. They may own a piece of that DST, and therefore they're a certain beneficial owner. We typically, on stuff that we're involved in, although we represent outside DSTs too, but we'll co-invest in a lot of our stuff. But the GP level, or that person, is actually in our world called the trustee. So they're the trustee of that DST, and they're making all the decisions. So just as if, going back to my family trust, I could assign you, Kevin, as the trustee of Shay and Kim's family trust, and you would make all of the decisions. And so that's kind of how it is. So all beneficial owners, are passive. They don't make the decisions, and that trustee, which is the sponsor, does the day-to-day.
Got it. And who is your typical client? Like, who is the normal average individual that you're working with that is going to utilize this DST structure to exchange funds out of one property into one of these DST properties?
So, we in today's world, we kind of have three different investor profiles. Mm-hmm. The first and most common profile is going to be, your person who has established themselves. They're in a position where, they've maybe managed their assets for 10, 15, 20 years, and they're looking to retire or have fun, whatever it may be. And they're just looking to be passive. And so that's historically where the DST structure over the last 20 plus years has received equity from that profile. Mm-hmm. Over the last 5 to 7 years, the second profile is professionals. A lot of people in today's world in certain sectors, you're a doctor, you're a lawyer, you're an entrepreneur, you're investing a lot of your time into whatever you are focused on, your business, working 80, 90-hour weeks, whatever it may be. You have a lot of capital because you've been successful. And historically, you would, want to invest in real estate. You have to manage, and that's a whole nother thing you have to do. And so the younger professionals or established professionals, we're starting to see more and more of that in the DST sector. Another thing that I think is interesting, a lot of people don't realize, is in the DSTs, you can also do a cash investment into them. It's not just for 1031 exchange funds. And so a lot of younger or, mid-career people are investing cash, and then the potential value of that is you can exchange down the road. So you do a cash investment today, there's that liquidity event. You could have an option with the current tax law to do a 1031 exchange, where if you were in an LP GP situation, liquidity event would cause a capital gain most likely for you. The third, not to make this long-winded, third type of investor profile in today's market, really the last 3 years, where you have a very competitive market on buying properties, is people utilizing us for a backup strategy. They want to be hands-on. They're still in their hands-on mode. They want that control, but to have a failed exchange and lose 30+% of your gain, they're utilizing us as a backup strategy on their identification sheet or a cover. They have a $10 million transaction. They find a perfect $8 million building. They can use the additional delta of $2 million for the DST.
Got it. Yeah, it's a tough market out there right now. It's great if you're a seller, right, getting all-time high prices, but it's really tough being a buyer, right? That's typically how it goes. Yeah. Sell an all-time high, buy an all-time high. So
exactly. That's what you have to understand.
It's challenging finding that the ideal exchange property, and I'm guessing also there's there's a challenge. It's not just finding the property, but as you alluded to, one of those typical clients or customers that might utilize the DST strategy is the individual that they don't want to, maybe they don't want to even put in the effort to find another property. They don't want to go through that brain damage, and they surely don't want to be involved in the active management of that property. I think that those are the two key factors. Is more than likely, in my opinion, is probably why a strategy or a structure like this probably makes a ton of sense for like the average retail investor. Retail investor meaning like the smaller, small to mid-sized guys such as us. And it's very interesting. How about as far as the DST, does the investor in that DST, or I guess how's that categorized? So like I invest in a DST. I'm not a shareholder. What is it called when you own a portion of the trust? So, is there
you're a beneficial owner. That's
beneficial owner. Okay.
Yeah.
Okay.
Yeah.
There
exactly.
we go. Does the beneficial owner retain all the same benefits, such as depreciation, pass-through losses and things of that nature? Does it all work very much the same, the mechanics?
Yeah. And I not to go back to the family trust approach, but just as if we own our investments in, our family trust, it kind of acts like and not all trusts are like this, just to be clear, but the common trust, it's a pass-through entity. And so the investors absolutely get their pass-through potential benefits, depreciation, if an investor has that left on any schedule. Obviously in a 1031 exchange, investors carry forward their basis. So they could be fully depleted. There's ways to take care of that, take on more debt, buy more property, get some new basis, which can be utilized in the DST structure, but everything is passed through to the investors. There's obviously no guarantee of appreciation, no guarantee of rental income, just like all real estate. But any of that potential upside and potential, income coming in the door, if you're a 10% owner, you get 10% of that net, NOI, that net operating income, 10% of that, upside potential. And that's the biggest difference between the DST structure and your typical GP structure or other funds is there's no waterfall split with the trustee. 100% of the upside goes to the investors. The sponsor, the trustee gets a disposition fee, but it's a fixed number, 1% disposition fee or something along those lines. And where your typical partnership, again, not bad, we do these too, but it could be a preferred return. You make X, and then anything above that, we as the operator are going to take 30% of the upside, and you take 70, which is fine and good. But the DST all gets passed through to the investor.
Okay, so even on the sponsor side, aside from that disposition fee, there's no asset management fee or any other fees associated on that sponsorship side?
Absolutely. So there's still costs, to get involved in syndication costs, and it's not to say there's no fees. And there's a private placement random that we're required to, give each investor that's going to label all the fees. And there's cost up front to put together a syndication, very similar to a lot of, I'm assuming syndications out there. And so we walk our investors, every deal and every operator is slightly different, but we walk at what that front and back end looks like. But again, they're fixed costs, right? They're not like a big number of 30% of the upside or something like that. From an ongoing perspective, there is an asset management fee. I would say most commonly, usually around 1% or so, plus or minus. There's some that are higher, 2+%. That's on revenue, on the gross revenue.
Mm-hmm.
And then the property management, that would depend on asset to asset. Obviously, if we have a FedEx building, we don't need a property manager there. But if we have a multifamily building, we need a property manager, and that's going to be whatever that going rate is in that particular region or market.
Mm-hmm. Got it. What is the typical profile of one of these properties? I mean, I'm assuming for the most part, they're stabilized properties. I mean, these aren't value add, massive, properties that need massive renovations or anything like that. Is that a correct statement?
Yeah, that's correct. So everything would typically be, there's always an exception to the rule, but 90% of everything in the DST world is typically considered fully stabilized. Some multifamily, there may be some light value add, components that are taking place. Maybe they're budgeting, $5 to $10,000 a unit to do your cosmetic upgrades as those units turn. And there's definitely value to that, but it's not getting in and doing full, repositioning of assets.
Got it. And I was unaware of this until I read through on your website. I just, for anyone that gets into real estate, if they've done any research, they know that real estate, for the most part, is illiquid, right? It's if you need your money readily available, you probably should put it somewhere else other than real estate. And
correct.
Typically these are, for the most part, and when I think of DSTs or anything similar, it's a long-term strategy. It's not hey, I'm going to put my money here, but I expect to get it back in 3 years because I might need to use it for something else. And so I assume that there was no secondary market, but per your website, it looks like maybe it's something you guys actually developed. You guys have your own a secondary market for those that might need to get out or need liquidity out of that DST. Can you speak to that a little bit?
Yeah, correct. So, over the years, and I believe we do a good job of everything you just said. We walk investors through, hey, this is the business plan. These are still considered illiquid vehicles. And, most real estate investors understand that. And if it's not, we tell them this isn't the product for them. And like you just mentioned, there's other liquid investment vehicles out there that they should consider. But we do understand that things pop up, in people's lives. And so we, ultimately created a platform for people to sell their interest or a portion of their interest, whatever it may be. The only caveat I would say to this is it's not a stock market, so you still can't get on and sell overnight. Mm-hmm. But the beneficial interests are considered transferable securities or sellable securities. And so, every year we do have successful transfers and sales of properties, but it is real estate. So, it's going to come down to how's the real estate performing? What, where are we on the market? If you come to us in 2009 or in March of last year in the coronavirus, it's going to be harder to sell your interest at that point in time. But, that would probably be the same for any real estate out there. But yeah, the secondary market's unique. The other great thing with this, the technology world and entrepreneurs out there, we started to see firms do this more in the tech world. Maybe an entrepreneur that is selling their company and they have a lockup period where they can't liquidate, X amount. And so those venture, people that went public on something, there's firms that have come out to create a secondary market to buy them out, for obviously a discount. But those same type of firms are starting to come into the real estate world and do that for people that are locked up into, general partnerships, DSTs, TICs. And so we've made a couple of good connections where we can refer them off to that if they're just trying to quickly get liquidity, because those people act a lot faster.
Yeah, got it. One of the questions I wanted to ask, I forgot earlier on, was, is there typically debt on these properties? Are they leveraged?
So I would say a majority of the DST market does have a leverage component on the properties. Probably about 70% of the deals out there that exist. But we do have debt-free verticals as well, because there are a lot of clients, especially people that are retirees or coming up on becoming retired. They want to just be in a more defensive position. And so the debt-free DSTs have become very popular. I'm invested in a bunch of DSTs myself, and I would say about 80+% are debt-free. It just gives you a lot of flexibility. away from the obvious of foreclosure risk is the exitability. As we all know, with debt, you have defeasance and prepayment penalties. So if you had an opportunity, say Amazon, we have a property where Amazon HQ2 recently moved to. We bought that property prior to them announcing that location. But when that happens, all of a sudden, all the properties skyrocket, right? And there's all sorts of unique, look at Austin and Dallas and all these places. Well, you may have built so much unlocked equity in your property that it makes sense for you to now reposition yourself to actually get all your money working. If we had a loan on that property, our defeasance or our prepay may inhibit us from selling because it wouldn't make sense. But because we're debt free, it gives us that flexibility.
Got it. Okay, and I'm assuming as far as the bad boy carve outs and all that, the sponsors are the one that are signing on that. Right? That's
a great point. Yeah, no, absolutely. This is one of the bigger differences between the DST structure and the TIC structure is the sponsors are the ones signing on the loan docs, those trustees. So they're signing all the carve outs or bad boy carve outs. Mm-hmm. And obviously you still have risk as an investor from the standpoint of you can lose your invested capital, but it's non-recourse. So you can't lose, beyond that.
Gotcha. What are some of the disadvantages of investing in DST? Obviously, there's no guarantee. So I think we kind of covered that, right? You could lose your investment, but are there any other potential downsides? And this isn't applicable maybe to every potential client, but I mean, what are some of the other commonly asked questions that you guys get from potential customers as far as, is this the right or is this not the right fit for me? Let's focus on not the right fit. Why might it not be the right fit?
So the most common kind of speed bumps or hurdles that certain investors have to get over if they want to go this direction. The illiquidity that we just spoke about. So that's one. The passive nature. Even though someone might say they want to be passive, it's hard for certain investors to actually, when they have to make their decision to become passive. If you've been hands-on for 25 years, that's a lot harder to do than most investors think it is to just let go. And then the obvious, as we talked about a little bit, there are syndication costs. And at the end of the day, if you went out and bought that multifamily building that we're putting into the DST or that FedEx, you'd be making a little bit more of a return if you did it yourself. And understanding that cost and being comfortable that, hey, yes, I'm going to make a little bit less money than if I did it myself. But is that worth the passive? Is it worth the diversification? We haven't really talked about that, but I think that's a huge one, not especially these smaller investors that might only have anywhere from a couple $100,000 to a couple million. It's hard to find quality assets under $5 million these days. I know they exist out there, but it's hard in a competitive market. And so to over concentrate yourself into a single asset, coronavirus proved this a lot, our strategy of also being geographically diversified. Mm-hmm. I think going forward, we're going to, unfortunately, always politically be divided. Things are constantly going to be changing in different areas of the country. And to not be over concentrated in one location, I think is huge. And that's what DST's crowdfunding, I guess, has provided the world, is to actually be able to get out. As we all know, back in, when I started in real estate, you focused in your one area. That was all you did. Because that's all you could do, really. But with the internet, we have the abilities now to get out there.
Yeah, no, you make a great point. And diversification is the key. I mean, generally speaking, but even more so now. Again, I hope there is a day, Chay, when we are not so divided. I would, again, I'm I haven't been around for that many decades, 4 decades, whatever. But I would say from as far back as I can remember, this is the most divided I've ever seen this country. And maybe some of those that are senior to myself can speak to another time. But I hope we get back to some type of alliance as a country and kind of work together instead of against each other. But in any event, no, this has been all great. I really appreciate you coming on here and sharing insights about the DST and K Properties and what it is you guys do there. One other question before we kind of move on to the exit of the show here is what is the typical minimum investment that one would have to put in, maybe through K Properties? Let's speak to your group. What is the minimum investment?
Yeah, and one thing that I think is important too that I don't think we mentioned on the front end of this conversation is that with the current regulations of in the investors that can invest into DSTs, because they are considered private placements, you have to be considered an accredited investor or an accredited entity. An accredited investor typically has a net worth of $1 million or more minus their primary residence. It's the high level definition. But with all that said, the minimum investment on a DST is typically $100,000. There is movement to bring it down. It's not a regulatory minimum by any means. I think it's the sponsor not wanting to have, 1,000 investors in one deal. So when an investor comes to us, if you do only have $100,000 or $200,000 to invest and you want to diversify, we can get those minimums lowered. But that's one of the beautiful things, as I mentioned earlier, even the cash investors, being able to go $50,000, $75,000 into these. But yeah, I would say the average investor is much higher than that, but obviously it's nice.
Sure. There was another question, and sorry, I keep thinking of things that I wanted to talk about that I might have forgotten in the beginning of the show. Is obviously this new administration coming in, looking to make a lot of changes. One of the I guess the threats that have been discussed was the elimination of the 1031 exchange. What are your thoughts on that, and ultimately, how could that affect your business and just really DSTs as a whole if that should go away? Yeah,
I mean, if the 1031 went away, it wouldn't necessarily be good for our business, obviously. And I think that's obvious. That's a general. It's not just DST land; it's real estate land and across the board. But what we've seen, to date with the current administration publicly, I think this is more along the campaign trail. They mentioned restrictions on the 1031, not necessarily total elimination. But kind of they've in certain articles they've mentioned that $400,000 if you make over $400,000 then you're going to be eliminated. The Clinton administration, they actually created a proposal. They also did limitations on how much you could exchange per year, and so it's all up in the air. And I would say over the last probably 3 to 4 elections, this is a hot topic every time. But yeah, I mean, it would be detrimental to, no one likes to use the terminology of like trickle down effect, but there's a lot of things that the 1031 potentially benefits all the way down to the city level of resetting property taxes, so there's a lot of things that I think come to the table through that lobbying where they ultimately don't do it. But this is kind of interesting time because there's a lot of very drastic things changing.
Yeah. Well, let's knock on wood and hope it doesn't happen.
Yeah, absolutely.
Well, Chay, this has been a lot of fun. I really appreciate you coming on here. What I'd love to do here is enter into what we call the golden nugget segment of the show. And this is where we'll work to wrap things up. And what I'd like to ask you is if there's one final golden nugget of advice or wisdom that you could leave with our listeners today that might inspire and motivate them as they progress in their own real estate career, what might that one last gold nugget be?
Yeah, I mean, I could probably speak to more of my generation, right? Of the emerging and recently established generation. But I think that, for me, and I probably wasn't thinking this way when it happened, but this is what happened is, just going for it. And whether that be in your career, taking the risks, it's the same thing in investing. If a lot of things sound a lot more intimidating than they actually are. And we all, as human beings, want to live in fear constantly and not take that next step. And being able to get past that. And then, I always had a coach that would say, hey, you're always going to take 2 steps forward and then something out of all of our control will push you back 1 step. Yep. And, and that happens in real estate investing and take calculated risks, obviously, but don't live in fear. And catch myself doing that all the time. Like you said, what if the 1031 goes away? What are we going to do with business? And you can't do that. You can't live that way. And when you get in that mentality of confidence and willing to take risk and willing to fail. I've had a lot of failures in my life, athletically and speed bumps professionally. It makes you stronger. And that's what I was telling my business partners. Hey, if they take away the 1031, actually, let's step back. We could do A, B, and C, and we're successful once. Why can't we be successful twice? And so that's kind of our approach.
Yeah, I mean, one door shuts, another door surely will open, right? It's just all about being open-minded and keeping your eyes open. And it kind of reminds me of many conversations I've had over these last 3 or 4 years. I know a lot of folks that literally have just been waiting for some type of depression or economic downturn to kick in, right? Because it just has to at some point in time. No one knows how to time it, right? So everyone's got dry powder on sidelines, and they haven't done anything with it for the last 3 or 4 years, and just sheer missed opportunities that they've missed out on over the last couple of years. I mean, just the costs associated with that. It's like, exactly. I mean, there's good deals in any market, and times are tough right now. It is tough to find a solid deal. It's great if you're a seller, as we talked about, but it's really challenging to be a buyer, to buy something at, I guess, what you and I might see as a great deal, right? I mean, so it's hard to buy things at a discount. However, there's opportunity all around this. You just might have to dig a little harder to find it nowadays. So in any event, absolutely. Jay, it's been a lot of fun having you here. For those that want to learn more about you and K Properties, where's the best place for them to head?
Yeah, absolutely. So, our website's pretty simple. It's just www.kpi1031.com. So K as in kite, P as in Paul, I as in investment, kpi1031.com.
Okay, fantastic. Well, Shay, thank you again for being here. And guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.